Hey there, everyone. Welcome to the Final Bar. It's Tuesday, July 23rd. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a lovely, beautifully sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. We're in the meat of earnings weeks, folks, which means a lot of companies reporting today. After the close today, we have Tesla and Alphabet, two of the Mag 7 names, along with a bunch of other charts to review. So quite a bit of choppiness going into the last 30 minutes of trading where we rolled over to the downsides, the major averages finishing lower. What does this mean relative to the big picture overall trends and volatility that we've been talking about? Let's get to the market recap and focus on what we learned from technical analysis applied to the markets today. The S&P 500, again, on a lot of this decline came in the last 30 minutes of trading. You saw the S&P 500 closing lower to around 55.56, almost perfectly the 555555. That would have been awesome. But we were 5555.74. That's down about 0.2% from Monday's close. The Nasdaq Composite slightly better, but still in the negative. The Dow down as well. So no real differentiation between the Dow, the S&P, and the Nasdaq. And I think that's important because a lot of times we've noticed quite a difference between those, and it usually has a lot to do with the sector leadership and laggardship, right? What was working or what was not on a particular trading day. Today, it's kind of everything kind of drifting lower kind of day, but not climactically low, right? We're not too far. We're a rounding error below where we were on Monday's close, but we, again, did not make any upside progress. The only green you see on the front here of our market overview on your dashboard is the S&P Mid-Cap Index, up 0.2%. The S&P Small Cap Index up 0.7%. So we continue to see small caps showing strength while the largest indexes or the mega cap indexes are struggling. By the way, if small caps are an area of the market that you are under aware or underappreciate the value of small caps, I'll be doing a webcast tomorrow on Wednesday, July 24th, 1 p.m. Eastern. If you go to marketmisbehavior.com/small caps, you'll see information about our upcoming webinar, Small Caps, Big Dreams, the Great Rotation of 2024. We'll talk about some of the macro factors that tend to affect small caps, what this might mean for 2024, some of the seasonal tendencies we have observed so far this year, and what is most likely to come July, August, September, and some of the different ETFs and ways that you can play the small cap space. Again, sign up for that free event at marketmisbehavior.com/small caps. I hope to see you at the event tomorrow on Wednesday. The VIX moving slightly lower, remain below 15. I think that's important because for me, 15 is sort of that basic threshold. A VIX below 15 means market conditions are just fine. A VIX over 15 tells me we're probably in a pullback mode. Now, after last week's sell-off, the VIX did push above 15. As of Monday's close, it had popped just below 15, and today drifting a little bit lower as well. I think that's important to watch through this week as we have a bunch of earnings coming up. And we also have the latest inflation data, the PCE number coming out on Friday. See if volatility increases. I can't imagine that it wouldn't, but boy, I've been wrong before, that is for sure. The 10-year yield, $TNX on our platform, moving slightly lower along with the rest of the yield curve. Not a ton, though. Kind of popped higher as bonds sold off a little bit going into the close. 10-year yield is currently right around 4.25, 4.24, we'll call it. The long bond yield is just below 4.5%. The dollar index did push slightly higher, but not by much. Really haven't seen that big, strong dollar move. And that would be sort of one of those big, risk off signs. If you're looking for warning signs of a correction, I'd be kind of looking at three things right now. The dollar, do you see a spike in the dollar? We have not seen that yet. Do high yield spreads widen out, showing the bond investors are getting nervous? We're not seeing that yet. Spreads remain fairly narrow. And then the third would be a spike in volatility. And we did see a bit of that, but again, hasn't sustained, right? The VIX remains now below 15 so far this week. Looking at the commodity space, gold and silver actually moving slightly higher. Crude oil in the red, and the energy sector was the worst performer today. So sort of the energy-related things were all in the red, along with copper. Precious metals actually moving slightly higher. And what I would probably sort of generally consider as a bit of a defensive rotation, but Again, just one day, it's hard to draw too many conclusions from it. Cryptocurrencies overall in a bit of a steady decline, particularly Bitcoin. It's currently just above 65,700. That's down about 3% from yesterday. Ether price is actually moving higher. There was an announcement of Ether ETFs being approved, and that certainly could cause a bit of a differentiation. I think a lot of investors that are not playing the crypto space tend to think of it as one homogenous group. It's kind of like all the cryptos kind of move up and down together, and certainly there are times when that happens, but I think cryptocurrencies are a lot more like commodities, and I think more and more people appreciate that reality. There are very different types of coins with very different levels of utility and purposes. Some of them with absolutely no practical purpose or value, but some like Ether, really foundational of I think emerging technology and where we might be headed. So for what it's worth, I would not think of them as a homogenous group of things, but think of them as a group of loosely related but very important digital currencies. You will note here on the sector summary widget, only 2 of the 11 S&P sectors finished in the green. That is not a bullish day by sector standards. Materials is your top performer, up 0.4%. I mentioned how precious metals actually had a nice up day while the rest of the equity space was down. So part of that is related. The financial sector actually slightly higher, about 0.2%. Financials, a little more heavily weighted in materials, I believe, as well in the small cap index. So that makes sense. On the downside, energy, your big laggard, that was down about 1.6%. Utilities and consumer discretionary, rounding out your bottom 3. Technology and consumer discretionary, both moving slightly lower today. Going down to what we call the Magnificent Seven and Friends, these sort of mega cap leadership growth names. Amazon up over 2%, Apple and Microsoft both up about 0.5% on the downside. Tesla going into today's earnings report after the close, and we'll check in on the after hours trading here in a short while. Tesla actually trading lower by about 2% going into this latest earnings release. Nvidia and Netflix in the red as well. Let's go to a daily chart of the S&P 500, see how things are playing out through the course of the day today. Honestly, I would say no real change from the general assessment that we've been talking about. Yesterday, Monday was a bit of a bounce higher after the gap lower last Wednesday. 3 straight days of closing near the lows of the day. Monday was a bit of a bounce higher. Today, you really didn't get a lot of upside follow through. Earlier in the day, it looks like we're actually making some further upside progress, but that wasn't really sustained, right? You saw that rotation lower going into the close, a bit of a risk off move just in the last 30 minutes of trading. That actually makes it a down day, which says we're really not following through on the optimism we had on Monday. Again, I would say this is going to be an interesting week with a lot of potentially conflicting data points, a lot of companies reporting earnings. There's always that company-specific risk, but also sort of the issue of big names that have earnings wins or misses can dramatically affect indexes because of how they're weighted and just overall investor psychology based on the type of headline and the earnings win. But keep in mind, I still see this as a sort of holding pattern, as a trend follower. Looks like we're making a fairly consistent pattern of higher highs and higher lows. I would say that there's no significant sign of a downside reversal yet. I mean, you saw the short-term kind of tactical decline, but not enough of a rotation lower. By the way, shout out to fellow CMT David Pierce from the Portland, Oregon area. I was talking with him earlier today. We were just comparing notes on some of the broad market conditions, talking about Fibonacci extensions and some of the ways to think about potential upside targets. So it does make me think that if and when we would resume this uptrend, that's when you want to start using extensions beyond what we've seen so far to think about potential upside targets. We may have reached an exhaustion point of sorts. I know I think we mentioned briefly that DeMark indicators in recent weeks, particularly on the QQQ, had given a lot of sell signals. I was talking with Katie Stockton, another fellow CMT, about that phenomenon and looking at some of her work along those lines. But again, as a medium-term trend follower, I still see this as short-term weakness within the context of a long-term uptrend. The S&P below 5,400 is a very different conclusion. I would argue in that case, it's no longer just a short-term pullback. That could be the beginning of something deeper and more meaningful. So certainly keep an eye on how those charts continue to evolve. Just to talk briefly about small caps, right? The small cap index continuing to show strength. I mentioned our webcast coming up tomorrow. And again, marketmisbehavior.com/small caps if you want to participate in that free event. But again, I just continue to see differences between what's happening with the S&P 500 and the Nasdaq. This is the daily chart, the 2-year daily chart of the IWM. These are completely different charts. And there are a lot of times, going back in previous market cycles where small and large caps kind of look very similar. This is not one of those times. Look at the relative strength, which has spiked higher as the Russell 2000 has been now outperforming the S&P in the month of July. This is after breaking out of a consolidation pattern, making a higher low just in the last week. So making further upside progress. And I think that could be a really interesting theme to pay attention to. Another thing I just wanted to mention in terms of just thinking about market leadership and laggardship is to look at this chart, the S&P 500 bullish percent index. Just note what this chart looks like over the last couple of weeks. Look at the Nasdaq 100's bullish percent index. Do you see the difference? the very clear and obvious difference, right? As a technical analyst, these charts could not have diverged any more, right? You have the S&P bullish percent index spiking higher as more and more non-growth names have improved their technical configuration. You compare that to the Nasdaq 100, which has actually rotated lower here over the last couple of weeks as those growth names, those large cap growth previous leadership names are continuing to show deterioration. I think that is a trend really speaks to the dynamics here in July, and I think it could be a bit of a precursor of what to expect more of in August, maybe into a September market low. We'll see. Let's finish off today's show just looking at some individual names. You have a number of names actually having some upside reaction around earnings. Spotify came out before the open today, finished today up about 12%. That's after trading a lot higher earlier in the day. It ended up being a gap higher, but a lower close. And what I mean by that is we gapped higher at the open. Through the course of the day today, though, you didn't see additional buyers coming in, pushing that price higher. You actually saw the gap higher right above a key resistance level. And now we've traded back down to it. I'm going to zoom into the candle chart here just so you can see what I'm talking about. We're looking at that level back there from early June. We gapped above there, but instead of the stock closing up, right, meaning we open higher and then a bunch of additional buyers come in, people are actually selling that short-term strength, which to me gives me pause in terms of the upside potential of Spotify after today. This is sort of one of those it wasn't a gap and run where we gapped and then a bunch of buyers came in. For now, we gapped and then a bunch of people were thrilled to cash out around 335 or 330 as opposed to expecting further upside here. And we've traded right back to that resistance. So I think right around that 330 level might be pretty key. That's the peak from back here in June, and now we're retesting that level from above. So a very important price level to watch on the chart of Spotify. Let's go back to the daily chart of GE, ticker GE, which is now a GE Aerospace. If you remember, there was that sort of divestiture, that split between different parts of GE's business. This is GE Aerospace making a new 52-week high and indeed a new all-time high today. We're trading above that May peak. Here is the resistance. We had this nice run off of an October low. We then, over the last 3 months, have been sideways. Stock's been range-bound between about 155 and 170. Today, we finally get above 170. I'd love to see if there's additional follow-through after the stock was up over 5% today. Also in the industrial sector, you have Lockheed Martin, obviously a defense name, up over 5.5% today, making a new 52-week high with a nice follow-through. And again, this is a chart that has been in a pretty constructive pattern, having a number of pullbacks to an ascending 50-day moving average. We've been bouncing off of those. Momentum has never really gotten too negative. It's more classic buy on the dip sort of configuration. So today's gap higher definitely pushes it up. And I would say on a chart like this, always good to look at the weekly chart to see the importance of that breakout here. I'll look at the unadjusted chart to sort of see if that makes a huge difference. Yeah, a bit, right? So if you look at the unadjusted data, underscore LMT, look at the weekly chart, you can see we're trading right up to $500 a share, which was the peak in Q4 of 22 and in Q2 of 23. I like this chart above 500, but we've got to get out of there first. Phillip Morris is another one. We'll go back to the weekly chart, show the magnitude of that breakout, right? The last couple months have been a nice follow through, but on the daily chart as well, this almost looks like a technology stock over the last couple months, right? Higher highs, higher lows, continuing to make progress to the upside. I think that's a chart in a pretty decent configuration. Stocks with a bit of a downside reaction to report on UPS, which, in the industrial sector, I mean, it's interesting as a stock, but I've often found that delivery names like UPS and FedEx often can be a great sign of sort of demand from consumers, right? Because if you order things, usually UPS is going to be delivering them certainly for a lot of products and services. But this is a stock that really has been below a downward sloping 200-day moving average for the last 9-10 months, actually, right? I mean, if you look, continuing to fail to get above that 200-day moving average. Most recently, over the last 2 weeks, we've traded right back up to that descending 200-day, once again repelling it, and now we're at new lows here, right around 127. And if you look on an unadjusted basis, that was key support around 133 to 134 today. In my opinion, this is the type of chart you avoid until there are signs of accumulation. You want signs that this stock is starting to see buying power come in. And today's chart is today's action is evidence of the fact that is not happening just yet. GM, I guess we had GE on the upside. The other general, GM, actually breaking down. Now, this is not a huge breakdown yet because it is trading down to an ascending 50-day moving average. You see a bunch of higher lows in January and February, March, April, May, June, and now in July. Every month we have made a higher low as this uptrend has progressed. As we've sold off today, down over 6%, my question would be, do we hold that ascending 50-day moving average? Do we hold the June swing low around 45.50? If the answers are yes, this is still a pretty good chart. If the answers are no, this all of a sudden looks a lot more vulnerable. Note how those previous pullbacks have remained above their previous low. That's the sign of a strong uptrend. If that changes, that, I would argue, is more of a change of character. Materials, the best sector today, but FCX, not part of the fun, actually traded down a lot more. It's actually trading down to the 200-day moving average. You can see we actually closed back above the open. So that makes, if you know your candle charts, the hammer candle is where you have a downtrend, you have an open, a lower trade, then we close back near the highs of the day. It looks like a little hammer. Think of it as hammering out a bottom. It says the next 1 to 3 bars for FCX, more likely higher than lower. So nice short-term bullish signal for Freeport-McMoRan. Just to finish off, 3 stocks reporting earnings after the close. We'll look at Tesla first. We talked about that, what I'd call a pennant pattern, which is a big run higher, lower highs, higher lows, kind of consolidating here. Let's look at the after hours trade. And we're kind of in the midst of the earnings release. I don't want to draw too much of a conclusion just yet, but so far in the aftermarket, we're down about 2.5% to 240. So for now, still holding the 50-day moving average. I think it's going to be a lot of attention through the remainder of the after-hour session, but certainly tomorrow, see what sort of reaction we have to Tesla. We also have Alphabet reporting after the close today, currently trading higher, about 1.2% in the aftermarkets, around 184. But we're still sort of within this range. Alphabet's an interesting one because we've pulled back to an ascending 50-day moving average. So far this week, actually pushing higher. Holds that 50-day. I think this is a great chart and obviously a key benchmark name and a key name in the communication services sector, but it's a big if. We'll see what happens as we digest the earnings news. Finally, Visa. Now, Visa, not as big of a market cap as the other one, but still an important name, sort of that credit card payment processor kind of space. And I found that Visa can often be an interesting indicator about consumer spending and consumer appetite for taking on additional debt. You can see Visa reporting after the close again today, down over 2%. That's after being down about 1.1% earlier today, right at the 200-day moving average. Those are 3 stocks. Tesla with a key pennant pattern, Alphabet testing moving average support, Visa testing moving average support. Do those levels hold tomorrow as we digest earnings? If not, I think a dangerous chart. If so, maybe a great buy on the dips opportunity. That's our wrap for our show today. Thanks so much for joining us every weekday after the close. I'm Dave Keller with Stockcharts.com. Be well, stay safe, have a good night. Oh, hey, Elon. Yeah. No, you're fine. No, it doesn't sound crazy at all. Yeah, go get them. All right, bye now.